Good morning, students. I am Dr. Deepa Srivastava, Assistant Professor, Indian Institute of Tourism and Travel Management, welcomes you once again to the module related to understanding the balance sheet. Today, we will understand how to analyze the balance sheet. So, before we analyze, let us see what are the objectives of this session. We will recap the last session, what we have understood in the last two sessions. Then we will see how to analyze the balance sheet also. Then we will see the ratios which can be used for the purpose of analyzing the various components of balance sheet. So let us recap. Now balance sheet, it indicates the financial position as on a date or a particular point. So at the end of a financial year, it shows the financial position. It shows different resources from which money or money's worth was obtained from the business from its inception. That is, it shows the sources of fund and the uses of fund. So sources of fund can be in the form of assets. What are the various assets the company is going to have and what are the various liabilities? So these assets and liabilities shows the sources of fund in the form of inflow and outflow of resources in your organization. It shows the various forms in which money or money's worth has been employed in the business from its inception. So it shows the forms in which money or money's worth has been employed, that is the value of your assets and liabilities, and in what different forms, that what is the different categories of assets and liabilities which are there, which we have already seen in the last session. So that can be seen from your balance sheet. So now, let us start. Let us start with the analysis and interpretation of balance sheet. Now, balance sheet normally contains huge data and the figures, which we have already seen that the balance sheet can have a number of assets, different types of assets, and it can have a different types of liabilities also. Now, if you want to understand it, what is the relationship between the assets and the liabilities, what type of a relationship it is, what is the financial position of a company, whether the company is in a very good position, solvency position of your balance sheet, of your business can be known if we analyze, if we deeply look into the various values which are being shown in your balance sheet. We know that balance sheet is the statement which talks about the solvency position of your company. So it needs the analysis, understanding of it. What is the meaning of analysis? It is about breaking something into components. That is, huge data is there, huge information is there, and now we need to break those information or data into those components so that it is easily understood to us. Huge data and raw data into manageable forms, that is something which can be managed and which can communicate something meaningful is your analysis. So we select, we evaluate and interpret the data so that whatever is there in the balance sheet, we are in a position to comment about the solvency and the financial position of your company. So this is about the analysis. Now when we talk about balance sheet, how we are going to do this analysis and how we can interpret it, that is, we can study the balance sheet. So let us see that. Now, the purpose of this analysis is that we are going to have a very deep understanding about the relationship which is there between the different components of your balance sheet. So, for a particular period of time, what are the assets, what are the liabilities which are there to cover those assets, and then what are the type of components of your current assets, what are your current liabilities, are your current assets in a position to pay back your current liabilities, what is the quality of your assets and liabilities. So these are all things which can be studied when we do the analysis. We can also study the trend factors. That is, if we look the balance sheet of a company for a particular period of time, that is, if we study for 2 or 3 years, then we can see what is the trend, how the assets are increasing or decreasing, whether the quality is increasing or deteriorating with the time period. So this kind of analysis is only possible when we go into the thorough interpretation and analysis of the various factors. Now, when we do the analysis, we can divide those analysis into these 4 categories. It could be internal analysis, it could be external analysis, it could be horizontal, or it could be vertical. Now these internal and external are just opposite of each other, and horizontal and vertical is also just opposite. Now let us see that. Internal analysis. Internal itself says that when it is within the organization. So internal analysis is within the firm. That is, a business or a firm is going to study its own balance sheet. Then in that case, they have the access to the books of account. It is very easy for them to get all the details or all the information which is related to their balance sheet, because it is an internal analysis. It is an analysis within the organization by the people who are there, that is the executive and the employees. They do these kind of analysis when they want to take certain decision, when they want to understand the solvency position, when they want to understand the financial position of their company, when they want to take certain decisions which are going to have a long-term impact on their company. At that time, the companies go for such kind of an internal analysis also. Sometimes the organizations or the regulatory agencies which have some kind of a jurisdiction power, that is, they are also a part of their board or they are also a part of their shareholders, then they can also have such kind of an internal analysis to understand the solvency position of the company. Now, external analysis. It is just opposite of your internal analysis because it is done by the external people. That is the people who are the outsiders. They could be the investors, they could be the credit agencies, the government agencies, etc. So the bankers, they can go for this external analysis before giving the loans or before extending help to the business. They want to understand that whether you are solvent or not, what will be your ability to pay back the loans in future. So they can go for external analysis. The credit rating organizations or agencies, they do the analysis of the balance sheet of the company to comment about the credibility of the company, the solvency, the future performance of the company. So, but the problem with this external data analysis or external analysis is that the data is available only as a published balance sheet. So in internal analysis, you had so many internal access to the internal data also, the data which is not there in the balance sheet. But when we do external analysis, we only have the published balance sheet for the analysis. Then we have horizontal analysis also. What is this horizontal? That is when the balance sheet for a number of years are reviewed and analyzed. We called it as horizontal analysis. So a company wants to study the trend. So the company is studying the 5-year balance sheet of that particular company. So 5-year balance sheet has been put and then they are studying the various components of the balance sheet. So this is horizontal analysis. It may move over a number of years. That is what I said. For 5 or 6 years the data can be analyzed, or it may be across many firms. So the data of 5 companies for the year 2019 and 20 can be analyzed. So then it is also a horizontal. So either one company can take a data for 3 or 4 years for itself, or it could be across the firms also. And because of it, we called it as a dynamic analysis also. Now, what is the purpose? What this is going to help? It enables the owners, that is the shareholders, to know at a glance the amount of total funds owned. That is what you own in the form of assets and what you owe to the others in the form of liabilities. And it is very useful in comparing the performances also, because you can do across the firm analysis also. So what it gives you the understanding of the performance of different companies which are there in your industry. So within an industry, what is the performance of your competitors? That can also be seen if we go for horizontal analysis. Next we have vertical analysis. Now this vertical analysis, it involves finding out the relationship between 2 items in respect of the same firm in the same year. That is, within 1 year I am going to study that what is the relationship between the two items. So this is called as vertical analysis, and it is called as static analysis also, because for a 1 year or for the same year for the same firm I am trying to understand what is the relationship. So what is the relationship of my assets with my liabilities in the year 2019 and 20, or what is the relationship between my current assets and current liabilities in the year 2019 and 20. So that is a vertical analysis. Now look at this balance sheet. Now this balance sheet we can use for a vertical analysis. We have the different components of assets, we have different components of liabilities. Assets are divided into current assets and current liabilities. Then there is a shareholders fund. We have a type of share capital also. We have reserves and surpluses. Then we have a type of long-term liabilities which we have written as non-current liabilities. Then we have current liabilities. So we can study a relationship between these current assets and current liabilities, or your fixed assets and your fixed liabilities, or your shareholders fund with your total liabilities. So this is how we can use this particular one balance sheet to do the vertical analysis also. Now this analysis, that is vertical analysis or the horizontal analysis which we are doing, at that particular time businesses normally go for ratio analysis. This ratio analysis is one of the very important tool of analysis, because what we are doing in analysis, we are trying to study the relationship. It could be across the years, it could be within the years, it could be within the firm, or it could be with your competitors. So when we are doing this analysis, we need certain techniques, we need certain tools. So financial ratios is one of the tools which has been very extensively used by the organizations to study the relationship. So what is a ratio? It shows the relationship between two numbers. Ratio, it has always to be calculated to show the relationship, but it is a relationship between the numbers, between the figures. And why we do this? Because we want to check the financial condition or the performance. So when we want to study the relationship, we can calculate a ratio, and it is always between the two accounting figures. Figures has to be there, the values has to be there for which we are going to calculate the ratio. And it is the process of computing and presenting the relationship in your financial statement. So financial statement, n number of data is there, different type of assets, liabilities, expenses and incomes are there. So we want to study, we want to present the relationship. So how to present it? There should be some tool. So ratio analysis is a tool where we present the relationship between the different components of your financial statements. But if you are using this ratio analysis, we have to keep certain thing in mind. That is, this ratio analysis has to be used with little bit of precaution. We should be aware of its limitations also. When we do the interpretation, as I already said, that ratio is what? It is a study between the relationship between the accounting figures. So the interpretation of that relationship is very important, because it is just going to give you a ratio. Now you have to interpret what that ratio says. So that is why it is definitely a useful technique or a tool, but interpretation is very much important. And when we want to interpret these ratios, we have to keep certain things in mind. The first, the accounts can be unreliable accounts also. That is, whatever information is presented in your balance sheet, in your accounts, is it correct? There should not be any kind of a misappropriation. There should not be any kind of a window dressing on the data which is being presented to you. Second, when we talk about inter-firm comparisons, that is comparing with your competitors, it is little bit difficult. As I already said, that for such kind of an analysis, you have to rely very much on your published balance sheet. So other than the published balance sheet, we do not have any other data. So only whatever is there in your balance sheet, that is the basis of calculating the ratios. So inter-firm comparisons sometimes become difficult. So sometimes how you have defined your assets, how you have presented in the balance sheet, it could vary from firm to firm. So this inter-firm comparison sometimes become difficult. Then the prices are changing. Whatever is the price of your current assets, like for your inventory, definitely it would change. So sometimes when you purchase the inventory, the cost was something else, but at the time when you are preparing, you have prepared your balance sheets, the prices are different. Same within the firms, across the firms, the problems can be there. So when the prices are changing, we are following the historical cost concept also. So whatever we are showing in the balance sheet, it is for the fixed assets, it is as based on the historical cost. For the current assets, it depends on the policy of the firm. So problem is that there can be problems with the price changes. So how we are going to tackle that when I am calculating the ratios? Then the terms are different and the formulas are different. Somewhere you will find that one particular ratio has been defined differently. Somewhere it has been defined very differently. Then the terms. Maybe somewhere the equity will say, okay, this is what includes in that, and somewhere in some places you will find that, okay, when the firm was calculating this particular aspect, then they have not included. So that difference becomes very difficult to tackle when we calculate the ratio. Different standards are there. When we study the ratio, certain standards are being given to us, that is 2:1 is good or 1:1 is good. But within the companies or within the industries, these ratios will change. You cannot say that these standard ratios are applicable to everyone. Some company may have a bad ratio as compared to what the other companies are having, but that is bad only because as per the standard ratios given. But if you go into the deeper analysis of the company, you will find, no, that is okay. So different standards are there. Then you need a deeper analysis also. Just simply saying I have compared the published balance sheet of the companies and it is going to give me a better understanding, no. So if you find something is there in the ratios, something good is not there, some bad indication is there, for that you cannot simply rely, okay, whatever ratio analysis has said, that is correct. No, for that you need a better understanding, a deeper understanding. So along with the ratios, you should use other tools of analysis also. And then year-on-year data also. So sometimes it becomes very difficult to calculate or to make an analysis on the basis of this kind of a data also. So these are the certain limitations of your ratio analysis. But yes, limitations are there, but yes, these has to be used. It is a useful tool if we use it with certain precautions. So now let us see. This is an example of a company. And in this, I have taken the asset side. So the asset side, the different values have been given. We have the current assets on one side, and then we have the fixed assets, and the total of the assets has been given to us. Then we have the second part of the balance sheet also, which shows the liabilities. This shows the liabilities of the company. So we have the assets and the liabilities. Now we will take these assets and liabilities to calculate certain ratios for this company for the assessment year 2020. Current ratio. First we will calculate the current ratio. Now what is this current ratio? Basically this current ratio talks about the short-term liquidity position of a company. It is an indicator of the company that how well the company is able to meet its short-term liabilities. That is whether the company will be able to meet the liabilities which arise within one accounting period or within one operating cycle. It is used to assess the short-term financial position. That is what I said, the short-term liquidity of the company. It shows a number of times the current assets are in excess of your current liabilities. That is how many times your current assets cover your current liabilities. And it is generally accepted that if the ratio is 2:1, that is for every 1 rupee of your liability, current liability, you have 2 rupees in your current assets, then we say that yes, this is a good ratio. But as I said that okay, 2:1 is a standard ratio, but you cannot blindly believe on that because it changes from company to company, it changes from industry to industry. But as a standard, we say if it is 2:1, somewhere it is good. And then it says that okay, realization of assets, that is, it says that realization of assets will be sufficient to pay the current liability and the company will be able to meet the day-to-day expenses. So if it is a good ratio, 2:1, it means the company has sufficient of current assets and timely the company will be able to pay its short-term liabilities. So now let us see how we are going to calculate the current ratio. The formula to calculate current ratio is current assets divided by your current liabilities, and as I already told you that 2:1 is considered as a good ratio or a satisfactory ratio. So the same data which I have shared with you in the last slide, we have taken the current assets from there. So the current assets are around 5860.80. Then we have the current liabilities, it is around 4490.91. So the difference between your current assets and current liability is around 1369.89. Now this is another very important thing which we always see when we do the analysis of balance sheet. We always find out the net working capital. So net working capital is always the difference between your current assets and current liabilities. But now let us see what will be the ratio. The ratio is current assets divided by current liability, and here our ratio is 1.31:1. That is, for every 1 rupee liability we have 1.31 of your current assets. So the current ratio for this particular is 1.31:1. That is, for every 1 rupee of your liability, you have 1.31 in the form of current assets. So if the company is supposed to, or company will have to pay the current liability, they are in a position to pay it. But if they pay it, the remaining will be only 0.31 remaining with the company after paying for the liability. So another ratio is quick ratio. Now we will get into a deeper calculation of the ratio. Okay, so current assets, it includes all the current assets, but the quick ratio says, okay, all current assets cannot be converted into cash very easily. So if suddenly the company has to pay the current liability, it will be difficult for the company to convert the current assets into cash and to pay for its liability. So we calculate another ratio, that is quick ratio. Now the quick means it is a ratio between the assets which are very quick, that is, which can be easily converted into cash. So no time is being wasted to convert them into cash, and then we take a ratio with the current liabilities. So what are those assets which can be easily converted into cash? Cash is already there, bank balance is there, we have the marketable securities also there, but one kind of a asset is there, that is inventory, and we can also take the prepaid expenses. These are the assets which cannot be easily converted into cash. Inventory, the stock of the goods, raw material, finished goods or semi-finished goods. It cannot be very easily converted into cash, it will take some time. Similarly, prepaid expenses, these are the expenses which has already been paid. So how can you convert it into cash now? So when we want to find out the quick ratio, exactly how well we are in paying quickly the current liabilities, we calculate the quick ratio, and for that we need quick assets. So we exclude inventory and prepaid expenses from our current assets. So if we deduct these inventory and prepaid expenses from our current assets, the remaining assets are called as quick assets, and then we calculate this ratio between the quick assets with your current liabilities. It includes cash, debtors, bills receivable, bank account or bank balance with the company. So then the ratio, the best ratio, the better ratio for this is 1:1. That is, you should have that much enough of current assets, which quick assets, which can pay your current liability. So the better ratio is 1:1. Now let us see how to calculate it. The same example which we have taken, we have the current assets, and from that we have deducted the inventory. So now the quick assets are after deducting the inventory, because we do not have the prepaid expenses. So we have deducted your inventory, the stock, and now the quick assets with the company is around 4750.44. The current liabilities, it remains same, that is 4490.91. So now the net working capital in this way is your 260.44. And the quick ratio is between your quick assets and your current liabilities. So that is 1.06:1. Now if we refer to the better ratio which we have seen, that is 1:1, we will say yes, the company is in a good position, because to pay the current liabilities, they have that much of quick assets which can fully pay the current liabilities. So the ratio is 1.06:1. So this is the quick ratio, which gave a better understanding of your current assets, your current liabilities and your quick assets. Now, another important ratio. In your balance sheet, we not only have the current assets and current liability, we have another important component. We have another important part, that is the equity. Equity, the money which belong to the equity or to the shareholders, the money which belong to the owners. So that is why now we calculate the debt equity ratio. Debt means the total liability of the firm and equity means the money which belongs to the shareholder. Now, why we are calculating this ratio? Now, this ratio is helpful to evaluate the financial leverage, the dependence of the company on external financing. So we calculate the financial leverage. It is very important because we have to measure the degree to which the company is financing its operations through debt versus the fully owned funds. That is, what is the ratio between the funds which are being financed by the external people and financing by the internal people, that is by the owners. And it reflects the ability of the shareholders' equity to cover all the outstanding debts in the event of winding up of the company. So if the company is going to close, it shows the ability of the equity shareholders, the value of the equity in the company, that how well they will be able to cover all the debts which are there in the company. So the organizations, the companies which are there for financing, or the bankers who are there to provide the financial help to the company, they are very much interested in knowing this particular ratio. Even the shareholders, they also want to know the ratio. Now let us see how to calculate it. The ratio can be calculated. The formalized debt equity ratio is equals to all your liabilities, that is your current liability plus your long-term liabilities, and it is going to be divided by total shareholders fund or the equity. We will follow the same last example. From there we have taken the total debt was 8840.71, and in that particular data you have a shareholders equity which was 33.09.21. So the ratio is, we are going to divide the total debt, that is current liability plus long-term liability, with your shareholders fund, and the ratio is 2.67. Now, what is the interpretation of this ratio? Now, this ratio says for every rupee of the shareholders fund in the company, there is 2.67 of the lender's claim. Then lower the lender's claim to the shareholder, lower are the demand of the firm's earnings. So company will have to earn to pay these claims. So for that, this should be on a lesser side, and if it is less, it means the leverage is less, that is the dependence is less, and that is why we say the good ratio is 2:1. That is the acceptable ratio. Now, these were the certain ratios which we have seen related to the ratio analysis, which is very important part of analyzing your balance sheet. Now, this balance sheet analysis of balance sheet will definitely talk about the financial health and the financial position and the long-term solvency position of your company, the ability of the company to survive in the near future, the ability of the company to pay its fixed liabilities timely. And there are different techniques which can be used. Whatever techniques we have discussed right now, this is a part of it. So there are n number of other techniques which are being available. We can go for cash flow analysis, we can go for comparative statements, we can go for common size statements. So n number of other techniques are also being there. And this technique, this analysis can be done within the firm and outside with your competitors also. So depending on the requirement, what type of decisions you want to take, what type of information you want, the company can go for the type of analysis. Why? Because the decisions of the business, the stakeholders, the bankers, the financial institutions who are a part of your organization, it all depends on the analysis of your balance sheet. So that is why understanding, analyzing and interpreting the data which is there in your balance sheet is very important. I hope that this session would be fruitful to you and it would have given you a better understanding of what are the various type of analysis and how these analysis can be helpful. Thank you.